Hello there, traders. Welcome to the Markets in Three with me, John, Senior Market Analyst here at Anzo Capital. I'm here to demystify the markets, show you what has been happening in FX, and give you some ideas and opportunities to have a little look at. So, welcome to the live stream. We've had an influx of brand new subscribers, so I just want to say thank you to those, and just to give you a few little bit of insights about myself, Anzo Capital, and what we are trying to achieve here. So first of all, like I said, my name is John. I'm the senior market analyst here at Anzo Capital. I've been trading for over 10 years now. I've been working with numerous brokers over the years, prop firms, market news websites, etc., giving people an insight into the macro, insight into how you can use fundamentals in your trading. And I've traded everything from euro futures to commodities, stocks, and indices. So, what I'm trying to achieve here with Anzo is to break down the barriers to entry in terms of learning how to really read what drives the markets. I like to use macroeconomics. I like to use fundamental catalysts. I like to use commitment of trader reports for my sentiment reading. I like to use seasonal analysis as well in my trading, and you're going to see a whole bunch of that as you spend time with me over on this live stream and in future videos that we have planned. So, if you do want to find out more and you want to come see daily analysis all day, throughout the day, including extra videos, etc., then you can join the Anzo Telegram channel. Here is the widget. Scan that on your QR code, and you can enter the channel there. We also have a QR code here highlighting the website. If you are new and you want to check out more of what Anzo has to offer, please feel free to head over to that. So we're going to kick it off with the chart check. Today we're actually covering the biggest market move of the month, the NFP live preview, and how this could impact currency markets, commodity markets, and all sorts going into this trading week. But before I get into that, and before we get into the markets that could be impacted by the upcoming data, I want to go on with what's happening today, the here and now. And I'm just going to bring up a pen tool here because we still have some key job reports coming out today as well. We have the initial jobless claims coming out of the US. Yesterday we had the ADP employment change, and we didn't see great news out of that. So if I just change this to yesterday on the pro economic calendar here, we can see that we had the ADP employment change that came in at 44,000 jobs created versus the forecast of 70k, so down, and the previous of 95k. So we've seen that ADP job report. Now, sometimes this can be a bit of a precursor into NFP, but we'll discuss that in a little bit. Yesterday as well, we also had the ISM services PMI data come out as well, which came in at 54.1, below the estimates of 54.5, but still, pretty good, right? Nothing really there that I would say is really detrimental to the market. We actually saw on the ADP employment change a little bit of a boost in the likes of gold. ISM services PMI came in and dragged it a little bit lower, which was interesting to see. So let's go into the chart check for the day. The chart check for the day is going to be talking about gold and the key levels on that market. And then we're going to go into some NFP previews, right? So I've been looking at gold recently. Obviously, the market has broken out through these key structure areas. If we take a look at the daily time frame here, we can see that we've been consolidating towards that kind of the lows of $3,970 up towards the highs around that kind of $4,150 area. And the market has just been basically going sideways in and around this point until recently, until yesterday. Price broke out of that key structure and rallied to the upside. Now, I've put some key levels here in place just to have a little look at. So what I've done is I've drawn a market profile from the 1st of June to the end of June and looked at the monthly market profile, the monthly key areas. Now, what I noticed yesterday, there was a low volume area towards $4,241, and the market closed in that area. Today, we've actually opened and gone above it. So that means that we might be trying to gravitate to some further upside here. Now, the point of control of last month is trading around about $4,336. And the sort of next volume, low volume area is around that kind of $4,380. So there's still some room to go to the upside here. If anything, we could argue that, price is staying within last month's value area, and the likelihood is that we could see a continuation to the upside. But I like to also understand why this happened. Why did we get this big boost in gold prices? And if that catalyst remains, is a good idea to be looking for a continuation of this pattern. Now, like I said, we do have NFP tomorrow, so that can obviously make things a little bit difficult when trying to predict where the market could potentially end up. But why did we get this catalyst? Why did we get this move where we saw the market branch out and start to push to the upside? And it comes down to a couple of different things. So the first thing really was the fact that we had that poor NFP data, and data out of the US in general is a little bit poor at the moment. So if I just go over here, and we're going to go over to tradingeconomics.com, and what we're going to do is we're going to head over to the main page, and what we're going to do is we're going to scroll down, and you can see here it says the United States. So there's some precursor to this. We've started to see some data out the US come in a little bit lower. So if we look at GDP growth rate, for instance, right, the previous was 2.1. It was now 1.5. Okay, GDP annual growth rate previously was 2.7%, came in at 2.1%. So immediately I'm already looking at this and scoring this as like, well, the dollar is, weakening there. There was some positivity news in the unemployment rate. So we saw that go from 4.3% to 4.2%. So that's usually a positive for the US dollar. But when it comes to non-farm payrolls, 129 previously, last 57. And we'll come on to the preview in a little bit. Inflation, which is super important at the moment to the Federal Reserve, came in at 3.5% versus the 4.2%. And you can see where this is going. Inflation rate month on month was minus 0.4% versus the previous 0.5%, and so on and so forth. Even the balance of trade has come in a lot lower and is still on the negative side. So really speaking, the kind of key metrics where it comes to growth is weakening, employment is weakening, and inflation is weakening. That is all a precedent to see a currency weaken. Right, so the US dollar weaker. All right, so in that grand scheme of things, it's likelihood that we're probably going to see a dollar that is continuing to weaken. So if you look at the key data points, it is pointing to a lower US dollar. Now, if we take a look at what's happening in the Middle East, right, and we take a look at Brent crude oil has fallen from $100 a barrel down to $78 a barrel because of a potential deal between the US and Iran, where we may see the Strait of Hormuz reopen. That has driven prices of oil to the downside, which has also relieved the idea that we are going to see aggressive rate hikes because oil directly interlinks with inflation. So if we do start to see continuations of that downside inflation pressure in the US, then there's a good chance that we're going to see the US dollar continue to weaken. This is reflected really nicely on the dollar index chart, right? We can see that the price of dollar index was in a really strong upward trend. If we just look back to from May all the way through to the middle of July, the price of the US dollar index was bullish. We were making higher highs and higher lows there. The market then formed strong double top pattern around that 101 spot 50, and we breached through to the downside. We broke through and took out the previous swing lows. We've now trading down at 99 spot 50. So if we see price kind of continue to break lower, then that's obviously going to be a good fuel as well for gold to continue to the upside. Now, I think we need a pullback on gold personally to get involved with it. Obviously, the market has broken out here and has continued to rally. So we've broken out some of those key structure points. But we need to see a pullback if we want to get involved. You know, key areas that we can look at potentially are $4,200. That is the highs that formed on the 6th of July. That could be a good area. I like the idea of looking at the market profile and looking at the fact that we've have all this accumulation and key support around sort of $4,100 down to the $4,050 area. Now, will we get that strong of a pullback? We'll have to wait and see. But if we do, then that could be a good catalyst to look for gold longs from that area. But like I said, we do have NFP coming up, and that can be very difficult to kind of predict where gold could end up. But looking at the chart at the moment, we've rallied significantly. It's down to the fact that we've got that poor US dollar data. If we take a look at US 2-year yields as well, they have been falling too. And now we're back at kind of the supporting area at 4.18%. So if we see that continuation of this US dollar yields and US yields continue to drive lower, that's going to be supportive for gold. And that's why we're going to see a big boost to the upside, because it's all about how are bond traders pricing expectations going forward. Okay, so really interesting situation going on here on gold at the moment. It almost kind of lagged behind everything else, and then it's finally had that pop up. And the catalysts were around the macro and the sort of key data points for the US are really leading into something where we could see a potential, breakout and a move higher. Okay, so let's move on to the big story then. So the big story of today is NFP live preview, right? I wanted to give you some ideas of what could potentially happen with NFP, and it kind of intersects with what we're talking about here on gold prices, because NFP is going to be a big driver of what happens here. Okay, so the big story is NFP live preview, and I just want to bring first in the pro economic calendar, and we're going to have a little look at the pricing. And this is something that retail traders not necessarily don't have access to, but don't have a look at very often, right? So what I'm looking at here, I'm just going to zoom in so you can see it a little bit better on the stream, is we have non-farm payrolls on the economic calendar. Now, what usually you see as a retail trader is the forecast and the previous, right? Now, what I love about using sort of pro economic calendars is that you can look at the minimum and maximum as well. So the minimum is suggesting, if we see that or lower, it could influence a bigger move, right, of potential weakness, depending on what the event is. The maximum works the opposite way. It shows us what the kind of max expectations are, and if we get to that and above, that could have a large impact and a bigger move on the market, right? It's kind of suggesting that if we come in within forecast, we don't typically see a big move, but if it goes towards the minimum, if it goes towards the maximum, a bigger move is more likely, right? So let's have a look at non-farm payrolls data. So non-farm payrolls is forecast to come in at 80,000 jobs created. Previously, we had 57,000 jobs created. So what this is suggesting that we are going to see a bigger jump. Now, the minimum of that is 10,000 jobs created. So what does that mean? It means that if we see a miss and we see it close to 10,000 jobs or lower, that could be extremely weak for the US dollar, okay? Because that is basically saying that they're not creating enough jobs, right? On the other side of that, you got 140,000. So if we see this coming at 140,000 or above, that is going to be extremely positive for the US dollar, okay? Because that's going to tie it into a positive labor market. Positive labor market is going to influence more spending in the economy, which then tracks in with inflation and demand. Looking at the unemployment rate, so that is suggesting that it's going to remain unchanged at 4.2%. Minimum is 4.1%, maximum is 4.3%. Now, it's a little bit different with the unemployment rate. Lower numbers are better, okay, than higher numbers. So if we do see a 4.1%, again, that's going to be a little bit weaker, a little bit more positive for the US dollar, because that is meaning that there's more people employed, right? If it climbs, that means that less people are employed. Now, one key metric that we really need to look at and doesn't get enough attention is the average hourly earnings, okay? And the reason why is because if wages are increasing, right, then there is a possibility that inflation will increase because people have more money to spend. And what do people do when they have more money? They tend to spend it, right? So more money in the economy circulating around is typically, a fuel for inflation. So when we look at the average hourly earnings here, 0.3% on the forecast, so it's expected to remain unchanged. Minimum side of that is 0.2%, higher side of that is 0.3%. So, if we do see the forecast, it's going to be pretty positive there for potential US dollar. So you look at this in two scenarios. I always like to look at them in three different ways, really. Let's say non-farm payrolls beats forecasts on jobs created. It goes down or stays the same on the unemployment rate, and the average hourly earnings tick up. That is US dollar positive, right? If you look at that from the other side, and we see non-farm payrolls missing expectations, missing forecasts, unemployment rate climbs, average hourly earnings stay the same or fall, then that is pretty negative for the US dollar. If everything kind of comes in forecasts, don't really see much change, right? So keep an eye on this. Now, how does that look on charts, right? So like I said, on gold at the moment, there's a couple of areas that we can look at. The first one, obviously, is the resistance level up at 4375. So if we have a reaction that is positive for US dollars, the likelihood is gold will drive lower, potentially down to $4,200. If we see a reaction where the dollar is weaker, then gold could continue its recent advance up to resistance of $4,375, which were these highs that formed around about the 17th of June. If we go take a look at a different market, so let's have a look at Euro US dollar. Euro US dollar breaking out to the upside recently. We broke above that 114.50 again after poorer US dollar moves. We were in this kind of trading range for a long time. I like the idea of seeing lower prices on euro dollar to this area of 111.50 because I was looking for a big key reversal a little bit further away, but it just so happened that the reversal has now kind of formed where we're at. So looked for the reversal anyway, but now price has kind of given us that, and we've broken out of these kind of trend line resistance that have come through. But again, we can map this out pretty nicely. If we see a very, very strong report for NFP, then the market could trade lower, perhaps into the 115 lows or even to the 114.50. If, however, we see a negative US NFP, then that could drive prices up towards the 116 handle, which were these swing highs that formed back on the 15th of June. So very clear levels to work with, and we could see a breakout. Now, the way you can trade this, and what we usually see before a big news event, is a kind of consolidation, right? So the market can consolidate, and then a big news event happens, and we see a little bit of a move. Now, what I like to do is wait for the move to happen, and then mark up the area with the market profile, and then look for an opportunity, right? So let's take a look and see if there was an example back here. Let me have a little look on the let me go to euro dollar on MetaTrader, and we'll have a look at the last sort of NFP report, which would have been here. right, which would have been, I guess, the 5th of June. Right, let's just go to a 30-minute chart and we'll go back to the 5th of June. And I want to just have a little look at the reaction there, right? Very strong reaction in the market through there, okay? So this would have been the pre-market levels. And again, if you like, I like to use market profile. So, you know, what you could look for is the kind of the lead up to the event, looking at the kind of market profile of the day and looking for, you know, either a breakout of that or a break and retest. Now, in this situation, the jobs number was obviously very good for the US, and it may be shocked to the upside. So what we saw was a very large candle at 130, dropping out of the entire trading day's market profile. And what you noticed is if you actually just went for a bit of a breakout short here, stop loss above the breakout, above the candle high, the market just continued to drive lower because obviously that was a big shocking event. Let's have a little look and let's go back to May. I don't know how May's played out, but let's just have a quick look at how that might have played out. So I'm guessing the non-farm payrolls were earlier that month. Let's have a little quick look at our calendar. Let me just bring up and have a look at have a look at May. So it might have been, so it wouldn't have been May 1st, it would have been May 8th that we had the non-farm payroll report, which was here. Okay, so this is a good example. So the payroll report came out here, right? This candlestick here. So if I just draw a market profile, again, we can go across the whole session towards that level, right? We can see that the market at that time was breaking out of the value area high, right? Now, if you look at the area before non-farm payroll, so this minor consolidation area, you can see that the price was consolidating. It broke out a value area high, came back in, rejected the value area, and continued to trade to the upside. Okay, so when you look at these big market moving events, what you want to wait for is price to break out of those areas first, then look to get involved with the market. Okay, probably not the best two examples I could have given you there, but this is how I like to use it, and we've shown you before how you can use it on the likes of gold and things like that. If we take a look at maybe July's NFP report, I'm guessing it would have been this move here, right? Maybe saw euro dollar drive higher. Again, if you kind of look at that move in its entirety, big breakout of the area, wait for price to come back to support. So in this area here, it would have been this low volume area. It retested that zone and price rallied off of it. Okay, so this is how you can kind of start building in a bit of a bigger picture. That was a very large move, and what traders tend to do is they see this move and they try and catch it, right? They try and catch each and every little bit of it. Now it depends how big of a deviation that move has been, right? If you get a big deviation from forecast, then it's going to be a big move. So if I go to June, and we look at the average hourly earning, yeah, it was a massive deviation, right? So we actually saw, so actually, no, we need to go on July. June was a big deviation. That's why we saw that breakout and drop to the downside. Uh, if we look at July, so July came early. Again, big deviation. So we saw forecasted was 114,000 jobs, right? And he actually had 57,000 jobs coming out. Okay, so huge deviation from the forecast. That's why we saw a huge pop up in price there of euro US dollar, which ended up with a continuation of the bullishness of the euro dollar for the next sort of trading day, which was the 3rd of July. Okay, so NFP predictions is going to be an interesting one. If you want to drop your predictions down below, please do so. Let me know what you think. Are we going to see a positive jobs data, or are we going to see a negative one? And I'll be interested to hear your side of things. Let's move on to the skill of the day then, to the last part of the stream, which is I like to go through a skill of the day, kind of help you up level your skills as a trader. And today I want to talk about the Asia range breakout strategy. Okay, so this is a strategy I like to use as well when I look at potential opportunities in the market. I like to use trading sessions, and I like to use market profiles. So the way this works is, look at the Asia trading range, right? So when the market closes to London open, okay, so I like to plot a market profile, right, from the open range low to the Asia range high. And what I'm looking for is, how is price reacting to the market profile? Now, what a lot of traders do is they wait for like a breakout of the Asia high, or they wait for a breakout of the Asia low. But sometimes the Asia range is quite large, so it's hard to do that. So this is why I love using market profile, right? So for this instance here on the 5th of August, we had quite a large Asia range, right? And when London opened, we were actually trading above the day's value area, right? And in a bit of an upward trend. And what happened was the market pulled back into the value area high of the Asia range, right? Which was also that kind of high volume area, rejected it, and continued to push higher. Now, if I had waited for the breakout there, right, on this candlestick, I would have had to have bought there, put my stop loss below the low. This is a 15-minute chart, by the way. And I may have got a one-to-one return on my risk. Now, if I had waited for price to come back to a key market profile area after the London open, so let's say this this value area high, for instance, I could have took a long off of the rejection of the value area high. I could have put my stop loss below the point of control, because that is a strong area of support. And look, I would have got easy 2-to-1, maybe even 2.5-to-1 reward to risk ratio. Let's look at a different example. So this is an example where the range is tight, right? So the Asia range has been very, very tight. I'm using the pound US dollar chart here, and we can see that Asia range has just been very, very low. Look at that compared to the 5th of August. Look, the 4th of August was a very tight trading range. Now, when we have a tight trading range, the market is more likely to break out. And that's exactly what happened. We had a breakout of that Asia range high, and then the market continued to trade higher for the day. So in this scenario, when you have a very tight trading range, you can look to buy the breakout again, but you don't need to have massive stop losses, because the market profile is showing you that you can put your stop below the value area low. So let's say there, stop below the value area low, easy 2-to-1 for the day. Let's look at this scenario. This is probably my favorite type of setup, right? It's when we break out of the Asia range, but we come back to what's known as the point of control of the Asia range. This is my favorite trade. So you can see actually on the 3rd of August, we have a very large Asia range session on pound US dollar, right? You can see that we traded up from the 135s down to sort of the 134.60s. So we have like a 40 pip range. Now, what's happened is the market has broken out of the range in the London session, right? Pulled back into the Asia range point of control zone, right? Which is this high volume area here. And look what's happened. We've rejected it with a very strong rejection. And after that, the market has exploded to the downside, right? These are my favorite trading setups, right? If I go back to the one here, which we saw on the 5th of August, if I actually just bring in my market profile to the actual sort of trending part where we saw a rally, consolidation rally, look where the point of control is, right? So it comes and tests that point of control, rallies to the other side. I love trading from the point of control. I love looking for that accumulation area, breakout, continuation, right? Let's see if I narrowed this down. See, look, if I narrow it down on the 3rd of August, we have a similar situation. The market pushed down, it consolidated, it pushed down again, market came all the way back up into point of control zone, boom, big move to the downside. So you can look at the Asia range, but what I would say to you to add a different level to this, use something like a market profile, use something like a volume profile to understand where the key hidden levels are. If I was just to look at the value, the Asia range high and the Asia range low, I have no idea really where those key levels are, where the key areas of putting my stop loss is. You know, I'm just guessing at that point. But if you add a very simple indicator over the top, like a market profile, like a volume profile, then you have the idea of where the sort of hidden levels are. Within that, it can help with your stop loss placement. It can help with your targets as well, right? Because what I could do is look at the previous day, drag my market profile over the previous day, and I could say to myself, well, where are the key levels from yesterday? Where can I go and try and target? Look where this kind of 2-to-1 reward to risk ratio comes in line with. It comes in line with this massive pocket of volume starting to build up on this day, right? So if I want to narrow it down further, it's in this area here. So it comes all the way up into that zone, starts rejecting it, actually continues higher and heads through the point of control, which would have been, again, my kind of overall target for this would probably be this point of control area through there. So that's how you can use the market profile combined with the Asia range breakout strategy just to find better trading opportunities. I'm going to leave it there. My name's John, Senior Market Analyst here at Anzo Capital. Thank you for joining me today. Appreciate your time. If you did enjoy it, leave a like, subscribe if you're new. I'll speak to you soon.